How to invest in stocks in Australia. Hello everyone, I am Sora from Financial Advisor, and I hope you're doing well and staying safe. In today's video, we discussed how to invest in stocks in Australia. A popular approach to potentially increase your wealth over the long run is investing in stocks on the ASX, the Australian stock market. Here are some steps you can take to get started. Choose a broker. Find a reputable broker that suits your investment needs and budget. Online brokers offer a range of trading platforms and fees, so do your research and compare your options. Open a brokerage account. To buy and sell shares, you need to open a brokerage account with an online trading platform or a traditional brokerage firm. Fund your account. Open a trading account after deciding on a broker, and then send money into it. You can do this via bank transfer, credit card, or other payment methods accepted by your brokerage. Research the market. Learn about the Australian share market, its trends, and the companies listed on it. Understand the risks involved and identify the sectors or industries that interest you. Research and select stocks. Before investing in any company, you should research it thoroughly to understand its financial health, performance, and future prospects. You can use financial news websites, analyst reports, and company annual reports to gather information. Look into businesses that fit your investing objectives, risk tolerance, and time horizon. And the time frame. Create a plan that is in line with your financial goals and follow it. Take into account elements like dividend growth, profit growth, and financial stability. Place your order. Once you have identified the shares you want to buy, you can place an order through your brokerage. There are two types of orders you can place: market orders, which execute immediately at the current market price, and limit orders, which allow you to set a specific price at which you want to buy the shares. Monitor your investments. After buying shares, you should monitor your investments regularly to keep track of their performance and any news or updates related to the companies. You can also consider setting up alerts or notifications to stay informed of any changes, and be prepared to adjust your portfolio as needed. To better understand, let's look at a few examples. Example 1. Let's say you have done your research and decided to invest in shares of a well-known Australian company, BHP Group. You have opened an account with NAB Trade and transferred $5,000 into it. You place a market order to buy 100 BHP shares at the current market price of $50 per share. Your brokerage executes the order, and you now own 100 shares of BHP. Over the next few months, you monitor your investment and see that the share price has increased to $60 per share. You decide to sell your shares and make a profit of $1,000, $10 per share x 100 shares. Example 2. Let's say you're interested in investing in the healthcare industry, and you've identified a company called CSL Limited as a potential investment opportunity. You do some research and find out that CSL Limited is a well-established and diversified healthcare company, with a strong presence in multiple healthcare sectors, including pharmaceuticals, medical devices, and consumer health products. You also discover that CSL Limited has a history of delivering consistent growth and profitability, with a strong focus on research and development and a commitment to innovation. Additionally, CSL Limited has a strong financial position, with a solid balance sheet and a track record of paying dividends to shareholders. Based on this information, you decide to buy some shares of CSL Limited stock. You invest $5,000, buying 50 shares of CSL Limited at a price of $100 per share. Over the next few years, CSL Limited continues to perform well, with new product launches, strategic acquisitions, and expansion into new markets. As a result, the value of CSL Limited stock increases to $150 per share. Now, the value of your investment has also increased significantly. Your 50 shares of CSL Limited stock are now worth $7,500, giving you a profit of $2,500. You can choose to hold on to your shares and wait for them to potentially increase in value even further, or you can sell them and realize your profit. In this example, you've put the share market by investing in a well-established and diversified healthcare company with a strong track record of growth and profitability. By holding onto your shares for the long term, you've been able to benefit from the growth of CSL Limited and generate a substantial return on your investment. Example 3. Let's say you wanted to invest in a company called Commonwealth Bank, CBA. If you had invested $10,000 in CBA in 2010 and held on to the stock until 2020, your investment would have grown to approximately $30,000. This is a return of 200% over 10 years. However, if you had waited until 2012 to invest the same amount in CBA, your investment would have grown to approximately $21,000. While this is still a solid return of 110% over 8 years, it's not as high as the return you would have earned if you had invested in 2010. This example shows that timing can be important, but it's not the only factor that determines investment success. Other factors, such as the quality of the company, its financial performance, and the overall market conditions, can also have a significant impact on investment returns. Therefore, it's important to consider all these factors and have a long-term investment plan when making investment decisions. If your portfolio is losing money, use the dollar-cost averaging approach to your advantage. Dollar-cost averaging is an investment strategy where you buy a fixed dollar amount of shares at regular intervals over time. This strategy can help reduce the impact of market volatility on your investments and potentially generate higher returns over the long term. Here's an example of how dollar-cost averaging works. Let's say you have $10,000 to invest in a particular company's shares, but you're unsure about the best time to buy. Instead of investing the entire amount at once, you decide to use dollar-cost averaging and invest $1,000 every month for 10 months. Month 1, you invest $1,000 and buy 50 shares at $20 per share. Month 2, the share price has decreased to $18 per share, so your $1,000 buys 55 shares. Month 3, the share price has increased to $22 per share, so your $1,000 buys 45 shares. Month 4, the share price has decreased to $19 per share, so your $1,000 buys 52 shares. Month 5, the share price has increased to $24 per share, so your $1,000 buys 41 shares. Month 6, the share price has decreased to $17 per share, so your $1,000 buys 59 shares. Month 7, the share price has increased to $25 per share, so your $1,000 buys 40 shares. Month 8, the share price has decreased to $20 per share, so your $1,000 buys 50 shares. Month 9, the share price has increased to $26 per share, so your $1,000 buys 38 shares. Month 10, the share price has decreased to $18 per share, so your $1,000 buys 55 shares. After 10 months, you have invested $10,000 and bought a total of 485 shares at an average price of $20.62 per share, $10,000/485 shares. If you had invested the entire $10,000 at the beginning, you would have bought 500 shares at $20 per share. However, by using dollar-cost averaging, you were able to buy more shares when the price was lower and fewer shares when the price was higher. Over the long term, this strategy can help smooth out the impact of market volatility and potentially generate higher returns compared to investing a lump sum at once. However, it's important to note that dollar-cost averaging does not guarantee profits or protect against losses in a declining market. Remember to do your due diligence, seek professional advice if needed, and only invest what you can afford to lose. Investing in the share market involves risk, and there are no guarantees of returns.